I get a lot of questions about leverage, but even more than that, I get a lot of questions from people blowing up their accounts that don't even realize it's because of leverage. So I want to clear up a few things about leverage, which I hope at the very least makes you more aware about it and how it's being used, so you can at least try to be a little bit more careful with it. New traders seem to consider leverage as really exciting, or on the other hand, really terrifying. So what is the right way to think about it? Well, personally, I think of it sort of like a tame or caged animal. Like, fair enough, you can enjoy it, there's some benefits to it, but you have to respect it. If you don't respect it, that's when problems happen. But before we get into the whys and the why nots, let's answer one really important question before all of that. What the bloody hell is leverage? Now, some of you will already be aware that leverage isn't something that's solely used as a term in trading. It's also for investments, and it's also for business and finance in general. In fact, when it comes to business and finance, your leverage ratio is one of the most important ratios that you use when you're doing balance sheet analysis. It's also known as your gearing ratio, and it's basically showing you the ratio of debt capital to equity capital. And for trading, this is quite similar, except in trading terms, your leverage ratio is showing you the maximum that you can use rather than what you already have used. So for example, if your account has a leverage ratio of 100 to 1, it means that every single $1 that you have in your account has a usable value of $100. So your $1 is worth $100. And the amount of leverage available in the account will depend on the broker and what they're offering you, and we'll come on to that in just a second. For this video, we're going to be talking about Forex, and all of our examples are going to be using Forex. But the same is also mainly true for other asset classes as well. And if anything we talk about confuses you, then just leave a comment below and I'll answer all your questions. It's not a concept that everyone understands right from the beginning, so don't be ashamed if something confuses you, just ask away and I'll answer the questions for you. Forex is actually the best asset class to explain leverage with, because in general, Forex accounts offer the highest amount of leverage. And just by default, we trade large amounts with Forex. Let me explain. So with Forex trading, currency trading, we usually trade in currency pairs. And this is usually noted as the base currency first, followed by the quote currency. So for example, with Euro US dollar, Euro is the base currency and the quote currency is US dollar. And when we trade these currency pairs, it's always in amounts of the base currency. So one standard lot will typically be 100,000 units of the base currency. A micro lot will be 10,000 units of the base currency. So for example, with Euro US dollar, where I just said Euro is the base currency, a standard lot will be 100,000 euros. Now, obviously, most private traders won't have 100,000 euros to spare to open their trades. And that's why the leverage comes in handy. So for example, if you're being offered 100 to 1 leverage, it means that you can open a standard lot, not by having to put aside 100,000 euros, but just by having to put aside 1,000 euros, because it's 1%. 100 to 1. Now, unfortunately, guys, in the US, the maximum leverage you can have on a Forex account is 50 to 1. But outside of the US, the rest of the world, you can have unlimited leverage. But standard, sort of typical amounts for most brokers will be 100 to 1 or 200 to 1 accounts. These accounts that allow you to use leverage with your trading are called margin accounts, because the amount of money that you have to put aside is called margin. Margin can basically be thought of as the deposit that you have to put down for the trade. So for example, in a 100 to 1 account, you need to put down 1% as margin. So if one standard lot is 100,000 units of the currency and you have a 100 to 1 account, meaning that you have to put down 1% as margin, that means you're going to have to put aside 1,000 units of that currency. And this will be taken automatically by your broker and put aside for you. While your trade is open, then that amount of money that's been put aside as margin will be unavailable for you to trade with. So it might still show on your main balance, but in your available balance, your usable amount of money in your account, it won't be there. It's not going to be available. But as soon as you close that trade, it will instantly be available again. So it's not permanently taken off you. It's not a fee. It's just a deposit that gets refunded when the trade is closed. But hold your horses, because there are certain rules of that margin as well. So for example, most brokers typically will say that if your trade goes into a loss and it starts to exceed your margin by 10%, then they'll automatically close your trades at that loss. Now, before that happens, once your trade does start to eat into that margin, your broker will usually phone you and ask you to deposit some more money into the account. And this is called a margin call. So for example, let's say you have a 100-to-1 leverage account and you want to open a trade that's one standard lot on US dollar Japanese yen. This means that you're going to have to put aside $1,000. Now let's say that in your account your total balance is $2,000. This means that you have $1,000 as margin and $1,000 left available to trade with. Now if that trade moves against you as a loss by over 100 points and you start to exceed $1,000 worth of loss on that open position, then your margin is going to start to get eaten into. It's at this point your broker is likely to call you and ask you to deposit more money, and if it keeps going into more and more of a loss and it exceeds 10% of that margin, so that $1,000 that was put aside, so that means your loss is $1,100, then your trade could get closed out and your account will then be left as $900 or whatever's left of that margin. Guys, this is how leverage can be really, really dangerous. Right, imagine this. Imagine American Express gives you a credit card that has a $10,000 limit, but your salary is $3,000 a month before tax. So on average, like the maximum that you'll spend each month on luxury goods is $500. So that means with that credit card, usually to be able to spend within your means, you'll be spending $500 each month or thereabouts as a maximum. However, if you took that card and one month decided to spend the whole $10,000, then you're not spending within your means. And that means that you're going to get yourself into some financial problems. And this is exactly the same with leverage. Just because you have this big limit available to you, just because you can open these big position sizes relative to your account size, doesn't mean you should. You should still always trade within your means. And that is of course only ever risking 1 to 2% of your account balance on any single trade. And when I say account balance, I mean your actual capital account balance, not your capital with leverage applied. So it's 1 to 2% of the actual money you own in the account. And if you can stick to that, then leverage will never be a problem for you. Now, let me anticipate some questions that I'm likely to get from quite a few people because I've seen them before in my email inbox. So let's clear them right now. Now, firstly, people always ask me, how do I know when the leverage is being applied to my trades? Well, the answer is if you have a Forex account which has leverage applied to the account, which is most Forex accounts these days, then every trade is going to have that leverage applied to it. Because essentially the leverage is only defined by how much margin you have to put aside for each trade. If you're really intent on not using leverage at all, then only ever open positions that represent the amount of money you have in your account. So for example, if your account size is $10,000, only ever open one micro lot per trade. Now secondly, a lot of people say to me, well, can't I open like a really huge position size then and just set my stop loss closer because I can use leverage to open a massive size and just have a stop loss of 1 or 2 pips? Yeah, you can do that. You can have a massive position size and still only be risking 1 to 2% of your account just because your stop loss is only a few pips away from your entry. But if you do that, it also means you're an idiot. I mean, you've got to be bloody stupid to open a position size that's just disproportionately huge to the amount of capital you have in your account. You've got to be masochistic to do that. You've got to want to wipe out your account. If you're risking 1 to 2% of your account on a few pips, that means if you get negative slippage of a few pips, which often happens with stop losses, it's like risking 5% or maybe even 10%. And what if there's a spike? God forbid, you wipe out half your account. Just think, if you use the maximum 100-to-1 leverage, it's only going to take like 100 points to wipe out your account. Don't do it. And by the way, guys, just before we call it a day here, if you're taking your leveraged return, so the return that you made using leverage, and comparing that to the market and claiming that you beat the market, right? Just don't do it. You've got to strip out the leverage first and look at what your actual return is relative to the market. This is why the Sharpe ratio is such a great tool to use when you're assessing fund managers and their performance, because it can often be misleading if I say I made 20% return this year and it's from using a leveraged account compared to someone that made 10% on an unleveraged account. But we'll discuss the Sharpe ratio another time because I think it's a little bit complicated right now for this video. So guys, thanks a lot for watching. As always, if you like the video, please smash that like button, and if you want more videos about learning to trade, then make sure you click the subscribe button so you can join us. Make sure you sign up for the Inner Circle mailing list if you want to find out more about our unique and exclusive method of trading and get access to our exclusive 4-part video mini-series to learn all about that. And now, to see us out with this video, in the spirit of the US presidential election, we're going to play the Star Spangled Banner while showing clips of those brokers that are offering ridiculously high leverage, just trying to separate people from their money. They're good like that, a very useful service. If you want to lose some money, go for the high leverage. As always, guys, thanks a lot for watching. watching, take care, and I will see you soon.